Hi guys. So today I would like to talk about forwards and futures contracts on non-dividend paying assets. Okay. So let's consider we have a risk neutral probability measure given by P tilde, and the assumption is that under this risk neutral probability measure, all assets basically follow the risk neutral pricing formula. Okay. So we already know what a risk neutral pricing formula is. And risk neutral pricing formula basically states that the discounted value of these assets under the risk neutral probability measure are going to be martingales, right? So that basically the assumption is that all assets, all non-dividend paying assets, or all basically assets that we're considering in this example right now are non-dividend paying assets, and they basically, the discounted value of those assets under the risk neutral probability measure is going to be a martingale. Okay, and under that assumption we're going to study the futures and the forward contracts and their pricing. Okay, so let's basically first start with studying the pricing of a zero coupon bond. So let's assume that we have an interest rate process like before, which is given by R of t. Okay, and basically we have a discount rate process as well, and that basically is given by exponent of minus integral 0 to t r of u d of u. Okay, so this we've looked at in the previous lectures as well. This basically is the interest rate process, and this basically is the discount process. Okay, now what we want to do is we want to figure out what is the value of a zero coupon bond. So most of you might already be familiar what is a zero coupon bond. So let's assume that we basically are standing at time t, and we have a zero coupon bond that matures at time capital T. Okay, a zero coupon bond basically pays you $1 at time t, and the value of the zero coupon bond at small t is given by BTT. Okay, so zero coupon bond is a simple contract where you basically pay some price today for a future cash flow of $1 at time capital T. Okay, that basically is what a zero coupon bond is, and it's called a zero coupon because we don't get any coupon between time t and time capital T. Okay, so we don't get any interest payout between this time. The only payout that we get is basically we get the face value back at time capital T, and the face value for a zero coupon bond that we're considering right now is basically $1. Okay, and this basically would be the price of the zero coupon bond at time small t. Simple. Now, under our assumption, all discounted value of all assets are basically martingales. So let's use the risk neutral pricing formula on our zero coupon bond. So we'll get B T capital T times the discount factor, which is dt, is equal to expected value under the risk neutral measure of B T T dt given information at time t. This is just simple application of the risk neutral pricing formula for our zero coupon bond. Okay, now BTT is basically just $1 because that basically at time t we're going to get $1 back. So this basically is equal to 1, right? And now we can rearrange the terms in this equation, and we'll get BTT is equal to 1 by dt expectation under the risk neutral measure dt given information at time t. Okay, so this basically is a formula for pricing a zero coupon bond at time t. Okay, something that we should remember, and we're going to use this result when we're discussing forwards and futures contract. Okay, so now let's basically move on to discussing forward contract and how do we price forward contracts for an asset that doesn't pay any dividend. Okay, so let's do that. Okay guys, so now we want to study pricing of a forward contract on a non-dividend paying asset. So let's first understand what is a forward contract. So let's assume that we again are standing at time t, and we have a forward contract that matures at time capital T. Okay, let's assume that the asset, the non-dividend paying asset, basically is trading at ST. Okay, the value of the non-dividend paying asset at time t is ST. This is not necessarily a stock. It could be any other non-dividend paying asset. Okay, so the value of the asset at time T is ST. Now, forward contract is basically a contract that allows the buyer of the forward contract to purchase this asset at time capital T by paying some delivery price. Okay, so the buyer of the forward contract would enter into a contract with the seller whereby they agree that at time capital T, the buyer of the contract would buy asset by paying delivery price K. Okay, and this basically is called delivery price. Okay, so it's a simple contract where buyer and the seller basically agree that okay, the buyer of the contract at time T would buy this asset by paying some delivery price K, and we want to make sure that this delivery price is basically fair to both the buyer and the seller of the contract. Okay, so what we're going to do right now is we're going to figure out what is the fair delivery price of this forward contract so that it's fair for both the parties, and that basically results in the value of the forward contract today to be equal to 0 for both the counterparties. Okay, so when you enter the forward, one party should not have advantage over the other party. The value of the contract should be fair to both the counterparties, and the value of the forward contract should be equal to 0. Okay, and we need to basically figure out the forward price, which is basically the delivery price that makes that value equal to 0 for both the counterparties. Okay, so now the forward price is basically given by forward TT. So basically forward price of some asset S at time T, which basically matures at time capital T. Okay, the forward contract basically matures at time capital T, and the value of the forward contract at time T for this asset is given by this form, this notation. This basically is a forward price. This is not the value of the forward contract. Okay, this is the forward price, or in other words, this is the value of the delivery price that we agree on today. Okay, so forward price is basically the delivery price. The value of the forward contract is different from the forward price. The value of the contract when you initiate the contract today needs to be 0 for both the counterparties. Okay, and for that we need to figure out a forward price which is fair to both the counterparties, and the forward price is given by this delivery price. So we need to find out what is the delivery price that makes the value of the forward contract 0. Okay, so please don't confuse between a forward price and the value of a forward contract. They're two separate things. Okay? Okay, good. So now what we want to do is we want to figure out what is the fair value of this delivery price. So how are we going to do that? We're going to use right now argument of pure arbitrage to come up with the value of this delivery price. Okay, we're not going to use the risk neutral pricing formula or the risk neutral measure. We're going to use only pure arbitrage argument to come up with the fair delivery price. Okay, and let's see how that is done. Okay guys, so what we're going to do is at time t, small t, we're going to sell forward contract. Okay, what do you mean by sell a forward contract? When we were to buy a forward contract, we basically entered into agreements to buy the asset at time t by paying a delivery price K. Okay, that's what you mean when you buy a forward contract, that you're buying an asset in the future by paying some delivery price. By selling a forward contract, you basically are doing the opposite. Okay, you basically are selling the asset in the future and receiving a delivery price. Okay, that's what we mean by selling a forward contract. So we sell a forward contract on this asset. Okay, now because we sold this forward contract, we are obligated at time capital T to produce that, to deliver that asset, right? Because we sold the forward contract, so now at time T we are expected to deliver the asset and get the delivery price. Now, in order to basically make sure that we have the asset to deliver, what we're going to do is, the second thing we're going to do at time small t is we're going to buy the asset. Okay? When we sell a forward contract, as I said, the value of the forward contract is 0 for both the counterparties. So this will not give us any cash flow. Okay? When we buy the asset is trading at ST. So in order to buy, we need to come up with this much amount of money, or we need to shell out this much amount of money. So we get a negative cash flow, okay, of ST. But we don't have any money with us. Okay, we basically are working at an assumption that we have no money in our pocket, and we want to see if somehow we can arbitrage our way and make some money out of this. Okay, so we basically are starting with 0 money. So I don't have any money in my pocket to actually buy this asset. So how am I going to come up with this money? Well, we have a 0 coupon bond also trading in the market, and the value of the 0 coupon bond that pays $1 at time capital T is given by BTT. Okay, so what I'm going to do then is I'm going to short ST divided by BTT. This is the face value of the 0 coupon bond that I'm going to short. Okay, so this much face value of a 0 coupon bond I'm going to short, and when I short, because I've sold the bond, I'm going to actually get some money out. So I'm going to get a positive cash flow. But what is the cash flow that I'm going to get? Well, this is the face value of my 0 coupon bond, and each face value of 0 coupon bond is trading at BTT. So this is the total amount of money I'm going to get, which is plus ST, right? So I needed this money to basically buy the asset. So I'm going to use this money to buy the asset, and the net effect is at time T, I have 0 cash flow. Okay, so I've done all of these 3 transactions without generating any cash flow, but now I have these 3 positions. Okay, so basically I have sold a forward contract, I bought the asset, and I've shorted a 0 coupon bond. This much face value of a 0 coupon bond. Okay, now let's see what's going to happen to these 3 positions when we reach maturity, when we reach time T. Now I've sold a forward contract and I bought the asset. Okay, so because I sold the forward contract, I'm supposed to deliver the asset, but because I've already bought the asset, I have the asset sitting in my portfolio, so I can just deliver the asset, and in return I'm going to get a positive cash flow of the delivery price. Okay, so at time capital T, I deliver this asset and I get this delivery price. So these 2 positions basically result in positive K cash flow, and I've delivered the asset. Now I had shorted this much face value of 0 coupon bond, right? This much face value of 0 coupon bond at time T. Each face value of 0 coupon bond at time T is basically worth $1. So this much face value of 0 coupon bond is going to be worth ST by BTT. Okay, and because I shorted the bond, I need to now actually reverse my position. So I'll have a negative cash flow now, because I need to buy the 0 coupon bond, or I need to basically produce the face value of the bond. Hence, I'll get a negative cash flow of BTT. Okay, so this was the cash flow that I got from buying the asset and basically selling the forward contract. So I delivered the asset and I got this K back. Because I shorted this much face value of a 0 coupon bond, and now I need to cover. So I need to basically, put up this much amount of money to cover my short position in the 0 coupon bond. So this is a negative cash flow. This is a positive cash flow. This is the net cash flow I'm going to get at time T. Okay, and for this net cash flow to be arbitrage free, I need this to be equal to 0. Okay, because I started with no money. If I started with no money, no arbitrage argument basically says that I should not be able to get any money in the future. Okay, or basically should not be a free ride. And in order to make sure that I don't have any arbitrage, this future cash flow should be equal to 0. And for that to be equal to 0, K should be equal to ST by BTT. Okay, this basically is my forward price, fair forward price at time t. Okay, if this is the forward price that I fixed at time t, then the value of the forward contract for both the counterparties basically is 0. Okay, and we basically have entered into a fair forward contract, a no arbitrage forward contract. Okay, if the value of the forward contract, if the price of the forward contract is different from K, then we can take either this position or the opposite position to exploit that situation and make use of arbitrage. Okay, so by arbitrage argument, this forward price should be equal to ST divided by B of small t and t. Okay, value of the zero coupon bond at time t. If this is the value of, if this is the price of the forward contract, then there is no arbitrage, otherwise there is arbitrage. Okay, so in all of this discussion, you would notice that we've not really mentioned or used the risk neutral pricing formula. Okay, this basically, we came up with this forward price just by the argument of no arbitrage. Okay, but now we should also make sure that we get exactly the same formula when we use the risk neutral pricing measure and the risk neutral pricing formula as well. Okay, so let's actually now use the risk neutral pricing formula and see if we can agree with this conclusion that the forward price should be equal to ST divided by the price of a zero coupon bond. So let's do that.